We then boosted equity exposure back to an overweight after this China-US meeting, because our view is that the trade war is functionally over at that point in time, and that's what the market was signaling. I see this being a period where everything's flowing from fiscal. As a strictly a capital markets investor, you have to be long stocks, because the companies that make up the S&P 500, they're going to get theirs. They're going to feed at the trough of Washington, and they will get their cut. The segments that are going to get hurt are the cyclical areas of the economy that we've already seen, like housing. Everyone's mad, that's a good sign. Everyone's cutting you down, that's a good sign. Embrace that energy, because that's what fuels a bull market ultimately.
Hi, everyone. I had the pleasure of catching up with Warren Pies, founder of 314 Research, on Tuesday of this week. And I think what he had to say is going to surprise many of you. For one, he's expecting a rebound in U.S. equities. Now, that might sound like an unusual call at a time when stocks are once again getting buffeted by tariff headlines and bond volatility. Things are moving so fast, in fact, that I checked back in with Warren today just to make sure everything we talked about in our recorded conversation still held given the news flow. He said it does. If anything, it underscores his view that you can't predict or control politics, but you can make sure that you have a mental model that cuts through the noise. And he shares the framework he's operating from. It was a great conversation, so enjoy. I hope you have a fantastic weekend, and please remember to like and subscribe. Hi, everyone. I'm Maggie Lake, and today I'm talking macro with Warren Pies, founder of 314 Research. Hey, Warren, it's great to have you on again.
Hey, Maggie, it's great to be back.
So first off, congratulations are in order. Since we last spoke, there are now 2 ETFs that are based off of your research and models. FCTE, which that launched last July, is now joined by RAA, and you're a portfolio manager for both of them. So just give me the download. What are they about? What's the new one do?
Yeah, I appreciate the congratulations. There's basically both of the funds are based off of models that 314 developed and has run in real time for our clients for years. And these are the FCTE fund tracks the full cycle trend model. That's a stock selection model. We pick 20 stocks out of the S&P 500, rebalance every month. It's based on quality and trend. And I think our research shows that your trend systems should change if you're applying it to a quality universe. And so all that's in the model that is underlying that fund. And like I said, it rebalances every month, which means there's quite a bit of turnover. So it's ideal on a tax basis. It's ideal to be all that trading to be done in an ETF. The new fund, it came out on February 26th. So we launched it close to the top of the market. So, great timing, but it is not like a pure beta fund. It is an asset allocation fund. Real asset allocation model is the underlying model. RAA is the ticker symbol. There's within like the first 2 months, we've got 410 million in there, and it's been a rough 2 months in the market. So it's been a nice vote of confidence, and that's an asset allocation. We rotate between 20 assets. It's kind of I think it's our way of. And clients have seen it for years. It's our answer to this new world where 60-40 is something you and I have talked about for years. 60-40 is just not going to cut it. You've seen so much correlation between stocks and bonds, and you introduce alternatives into your portfolio. So we have an entire alternative sleeve, and we can flex that weight up. And the alternatives range from managed futures, gold, Bitcoin, gold miners, metals miners. We have energy as a standalone, because we consider energy an alternative at this point in time. Commodities, all of those are available to us in the fund. And so each month we flex that positioning up and down, and on a tax efficient basis. And so there was a lot of work. That was kind of a long-term, that model's been with us for a long time. It's the first model we launched along with the oil model at 314. And to do a fund of funds like that, it's, and keep costs down and make it a great product for investors. It really takes a lot of thought. And so, that's why it was, later in coming, but I think I'm really happy with how it turned out.
Yeah, that's awesome. I wanted to ask you about it right at the top, because I feel like, as you said, and we've talked about, in this environment we're in, we're all having to rethink diversification. look at, what we've got in our portfolios, ask smarter questions to our advisors if we're using an advisor. And you just nailed it. I mean, the last 2 months, we've seen correlations that haven't really existed in a while. I mean, not ever, but you've really got to, for most people's experience in the market, we haven't seen these types of things. We've got stocks, bonds, and the dollar all falling at the same time, people calling the U.S. an emerging market. A lot of conversation around tax, which may be changing, which we'll get to. So I feel like this is all time we have to kind of go back to the drawing board. So super interesting to hear that you've launched something that is across all of those asset classes. So congrats on that. Look forward to seeing great success from you on that. So let's just sort of close the loop here on this diversification question before I start hitting you with some thoughts on the current environment we're in. We talk a lot about it, about having to think past 60-40. What's the reality, though, based on what you see? Are most investors starting to diversify out of stocks or bonds? Or most of us still sitting across just a couple of asset classes? Where does the sort of recommendations hit the reality in terms of where you think most people are?
I think it's across the board. Now, I'd start by saying it's kind of I don't believe I'm saying anything groundbreaking at this point. We started 314 like this was our belief. We said this. We saw the pandemic and we were like, this is not going to cut it. We had statistics like if you go back and look at the 100 worst equity days from 1998 to 2021, bonds were up on I think 83 of those 100 worst equity days. So your bond book was hedging your equities. We saw that. We saw it was going to change, and it has changed. Now the risks are emanating more from the bond market to the equity market. So I think this is recognized, though, at this point in time. But the thing I hope that we are accomplishing with the fund is it's really difficult for advisors. It's really difficult for investors in general to put a system around that belief. You need some gold, and maybe you want to experiment with some Bitcoin in your portfolio, or managed futures. We found has been a great diversifier, but it's, you might want to flex that position up and down, because sometimes it's a drag. And so you need this system, which is what we're doing. And it's really difficult to create a system. The more assets you add, the more complex the system gets. And so that's where we're adding value, I hope, is that we've spent years researching how to blend these assets together and put them into one solution. And so that's where I think there's a disconnect. I think there's a belief that you need to diversify, but there's a real struggle for like, what is the quote unquote right gold position? I'll give you like a statistic that would trip people up, and it could trip, really anybody up if you're looking at it, even from like a quasi sophisticated statistical perspective. And so if you were to run an efficient frontier, and this is something that like maybe an advisor or a basic quant would do, you say, okay, what is the ideal mix of assets if I were to have stocks, bonds, and then introduce gold over like a 50-year time horizon? What's the ideal mix? And that answer that drops out of your classic full history efficient frontier is actually like 0%. I don't know if it's changed with this gold rally, but 0% gold weight over time is the correct answer. Now, if you're able to isolate the secular bull markets in gold, which is somewhat easier said than done, but I think we can understand when we're in the right neighborhood. If you can isolate that, then the gold weight jumps incredibly high during those secular bull markets. Double digit plus gold weight is appropriate, and that shifts your efficient frontier out. And so it just shows how I think that that's a stand-in for having the right macro thoughts and overlay in the right system to get you into gold. And it can be deceiving if you look at the whole history. So my point is just with all these assets, it's complicated. There are complicated questions on the quote unquote right amount to have. And that's what we're trying to do here. And so that's my feeling is that folks are really struggling with the implementation side.
Yeah. Well, we hear that all the time. I get the questions all the time. That's why I wanted to start by asking this. And then it says, what do I do? Because in this environment, people feel and understand they need to do something. So thank you for that. I didn't know that was part of the origin story too of the firm. So that's super cool. So complicating this, and I think giving us all anxiety about making the right move is this environment that we're in right now. I mean, it's been a wild ride. We kind of knew that when Trump was coming into office, but there's so much whiplash as everyone tries to track the news flow. And just today, just before we were sitting down for this chat, I feel like I saw two headlines that perfectly illustrate the challenge. One read, Bank of America says S&P 500 could return to record highs as sentiment improves. And then literally right below it, Jamie Dimon says the market is too complacent on tariffs and expects S&P 500 earnings growth to collapse. I mean, like, what do you do in that environment? You know, it's so hard. Both of them can't be right. So let's start with the trade side of things, since that's what sent everything into a tailspin. Are investors too complacent about the trade and tariff situation right now, given that we saw the 90-day pause and markets rocket back up 20% from those lows?
It's probably not you're probably not going to love the answer, but my answer would be no one knows, and that's not the right question, really. The right question about in that way to pose it, I would say, is to say, how do you, given the amount of policy uncertainty, because there is maximum policy uncertainty, especially when we go back to April, what's the right way to navigate an environment with such crazy policy uncertainty? And so to me, is there complacency? My best guess is no. I mean, my view, this is just a guess, and I'll explain how we're going to navigate it. My view from the beginning of this is that Trump's initial poster board that he pulled out on Liberation Day represented a draconian set of tariffs that were not going to stand up, that there would be a negative feedback loop that hit the White House and he'd have to fold. And the question was just how much pain do we need to extract to get us there? And that was my working hypothesis. But at the same time, we said, we don't have an edge here. Like even now, like I'm giving you my opinion. I think Jamie Dimon's a smart guy and has a great perch to judge earnings. But coming through these types of policy events, if I had a nickel for every time we heard one of these name brand guys tell us that the bottom is going to fall out of earnings or for the market or whatever, I wouldn't need to launch any more of these ETFs. And so the bottom line is I think that you need to lean on the market, the collective wisdom of the market and technicals. And so, we came through and we said, look, this is our base case, so that these things get rolled back. If they don't get rolled back, then get ready for, limit down days on the stock market and simultaneous selling the bond market. And we saw that, like we pointed out to our clients, from April 4th to April 11th, we had an unprecedented set of conditions. We had 10-year yields up 50 basis points, dollar index down 3%, S&P collapsing. And what made this period of time unique is that even though gold rallied in dollar terms, it was flat in Swiss franc terms, it was flat in euro terms, it was flat in yen terms. So we had a little taste of it. And then Trump did pivot. And I don't think it was just the bond market that caused him to pivot. I think it was a lot of stuff. Like it was a very scary time for anyone who understood markets. Like that was a shot across the bow. So he pivoted, he paused the tariffs, and then the China news happened. And so our view is that we needed to use technicals, though, that this was an unprecedented set of conditions, and we needed to see sentiment get into a depressed place where people were, basically dialed their positioning down. And then we also wanted to get technical confirmation. And that was basically the 1-2 punch we needed in order to dial our equity position back. Now, just to go back for a second and say, okay, well, because I think some of the interviews I've given what turns out to be a lot of interviews during this period of time, and I can still see there's some confusion over what our position was. Probably not in our clients, but for people just listening to these interviews. So we had been overweight equities through the end of last year into the beginning of this year, and then we got spooked by the initial tariff announcement on February 3rd, and we downgraded equities to benchmark weight. So we were riding a benchmark weight for equities, and our view is that we expected to see turbulence in the equity market with a bottom somewhere in April, with the announcement of these tariffs and tax season coming together to create something. Now, we didn't see the Liberation Day size tariffs, but we thought there would be a bottom in April. And so once we got there, we saw sentiment wash out, and we're like, okay, we don't have the technical confirmation, but we're not ready to get back overweight stocks yet, but don't de-risk anymore. This is how bottoms are set. So we then boosted equity exposure back to an overweight after this China US meeting, because our view is that the trade war is functionally over at that point in time. And that's what the market was signaling. So I know there was a lot there, but that was kind of.
No. So and again, just to underscore that, and I think this has been very helpful in giving people a sense that you have to have many things in your toolbox, because when the noise is, there's so much noise and it's real, right? It's just conflicting and you're not sure because none of us are inside the head of policymakers. You're really leaning on that technical framework to sort of deliver the signal it sounds like that you're looking for. And that's when you sense there was a bottom. What are you, and we'll get to some more of the crazy politics, because I think, you have to kind of look at that. But what are you seeing in terms of, now we've come back? So you got that right. We've come back from that low to just about break even. I think it was a little bit up on the year, but we're facing, it seems like, another, weeks of uncertainty. We don't know what's happening with tariffs. We've now got the budget bill, which is taken front and center as on the fiscal side. What are the technicals telling you about how stocks look here?
I think that stocks look pretty bullish. That
Really?
would be my view right now. I think look, you can either have good news or good prices, but you can't have both. And I would also, that's one thing I always say. And I also say there is a momentum and risk premium. And so like risk premium blows out, you get valued investors that come in and set a floor, and then some momentum investors come in behind it, and there's momentum to the risk premium. And like, those are kind of like heuristics I keep in the back of my mind. I think that all the negative news, the reason I bring that up is it represents the wall of worry. I get a lot of disbelief, institutional disbelief. Jamie Dimon saying the bomb's going to fall out of earnings. You have Paul Tudor Jones saying we're going to retest the lows. You have a lot of prominent people predicting bad things. Maybe, but what I'm going to say is that, going back to the way we made a decision early on, we're going to navigate this via technicals, and we got sentiment washed out. We had, just to give you a couple things, vol targeted funds went to the lowest equity percentage that we saw back to COVID. Rock bottom. They're now dialing that back up. Always a bullish thing when you get that, historically, very rare. We saw retail investors not nearly as bearish as the institutions, but at the actual lows, they got to a place that we had highlighted as a sentiment capitulation. And then strategists came into the year. One of our concerns is that strategists were so bullish on the market, they took their estimates for year-end targets down to 6,000 S&P, from 6,700 to 6,000. Massive move lower. The market has always bottomed within a 2 to 3 month period after that happens. So sentiment tells us we're in the right neighborhood. Then we got a bunch of technical confirmation. We had a series of breadth thrusts. On a standalone basis, they're not so convincing. We had the ZY breadth thrust, which everyone talks about. That's a 10-day moving average of the NYSE advanced decline line hitting 61+%, 61.5%. That fired Marty Zweig, old technician that was friends with my old boss, Ned Davis. And we weren't ready to move just on that, but then we got another breadth thrust which was 55% of NYSE stocks hitting 20-day highs. And when you combine those two things, the historic evidence is very strong for forward equity returns. So you have sentiment very washed out. You have breadth thrust. We had the NYSE advanced decline line make new highs. Again, a very bullish thing. Strategists capitulating, Wall Street capitulating, and prices moving higher. To me, that's how a bull market starts. Now, we could be wrong. All this stuff this could be that one case, but you have to play the odds. You have to play the probabilities. These are good probabilities from my perspective.
Interesting. It's like, I can imagine the picture that comes into my mind is that, you've got the TV on and all of the headlines and the tweets and, and then which feel unnerving and negative. And then, your dashboard of all the technicals is blinking. Hey, this is green. This is the bottom. This is the time to buy, and so you've got to kind of hold your breath through the emotional roller coaster of watching some of these headlines and just the sort of chaos that comes from them. So the other powerful narrative seems to be that, we have the potential for the bond market to blow up the equity market right now. Hyperbolic language. Not everyone's saying that, but there is this idea that, that the markets have woken up. Bond investors are going to demand to be paid for the fiscal largesse, the fact that it looks like the administration wants to plow these unfunded tax cuts through Congress, and again stimulate, but this time, unlike others, bond investors are not going to stand for it.
Yeah. Well, just a really quick on your point about the emotionality of TV and stuff like that. It just hit me today because I sent a tweet out basically saying, look, we think there'll be new all-time highs in the market. And I was on TV on April 7th, like the day before the actual absolute bottom. I said, I think this is about a bottom right here. And the comments on the video were just like scathing.
Oh, yeah.
And then you sent a tweet out today. It's like, oh, you tweet this out now? Like, everyone's mad. Everyone's mad. That's a good sign. Everyone's cutting you down. That's a good sign. Embrace that energy because that's what fuels a bull market ultimately. As far as the bond market, it is a real concern. When we upgraded stocks, we downgraded bonds, and we've been pretty bullish on bonds. We were overweight fixed income, overweight duration, going back to the very end of last year when the 10-year was about 4.6. And so when we made our move, it was, around this upper 4.4s level. And so not a horrible trade, but we expected more out of the long bond. We expected this disinflationary impulse that we're seeing right now to feed through a little bit more, maybe a little bit more fiscal restraint signaling before we got this kind of a pro-cyclical deficit blowout from the administration. But we didn't get that. And so we're back to not bearish on bonds at the moment, just benchmark weight. I see this being a period where everything's flowing from fiscal, like you said. If and we broke this tax bill down, it's changing all the time, so we don't know exactly how it's going to end up. But if they push this through, like a clean TCJA trunk tax cut extension, for governmental scoring purposes, expands the deficit by $4 trillion over a 10-year period, and that's just a clean extension. So I think anything above or below that is kind of where the impulse for asset prices lies, and as a shorthand. And the numbers we saw last was that the deficit on the extension was going to go up 3.3 trillion. And so you could argue, the Republicans are arguing that that's some cut. There's some cuts in there, meaningful cuts. But if you analyze it all, the deficit is the reason they're able to make that claim is because there's so many different tax cuts that are going to expire in like 4 or 5 years. And so they're able to gain back on the back end at the next election cycle. But over the next 4 years, it would be extremely blow out the deficit to the extreme. And they score it on a 10-year basis. You got to look at it on a 4-year basis through 2029. And so that was another fundamental factor that gets us seeing a potential bull case for equities. The trick, of course, like you said, is that we're going to have to thread a needle where the bond market doesn't cause the equity market to sell off. Our work is like suggested, because I do think we're in a cyclical period of disinflation, and that's still flowing through, tariffs notwithstanding. I think that we trade between 4.3 and 4.6 on the 10-year in the near term, which allows the equity market to move higher. And the other factor is when we study bear markets or sell-offs in the equity markets caused by rising yields, it usually is because of the speed at which yields back up. So if we can just calm down here, we're hitting to that limit where they start slowing down equity market advance. If we could just chill here for like a month or so, that would do a lot to refresh the bull market for equity. So I see it as a long-term risk. You always have to keep your time horizon straight in this. It's a major long-term risk. I'm a long-term bond bear. But I think it's important not to skip to the end of the story, but to read the whole thing and let it play out. And there is a lot of uncertainty around the bill still. So we'll see how that turns out.
Yeah, that's a great point. And I think that's why people worry about a Liz Truss type moment, right? Where you have a very sharp and sudden spike, which would, be uh, so disruptive to the financial system. I mean, that has larger implications. If it's not that though, can the economy thrive? It sounds like you're saying the economy can handle rates that are in the range of the upper fours. What's the pain point where
Well,
things
you know what?
are difficult?
It's funny because what I think we're setting up for, let's say they do this, they blow the deficit out over 2029 in the years through 2029, which is when we analyzed the bill last week, I don't know where it is right now, but when we've analyzed the bill, that's where we were at. And if they do that and we're running 7.5% deficits out through 2029, and that's with an assumed 3.5% effective interest rate, and there's no place on the curve where you can issue your debt at 3.5%. So, I mean, that number's moving up. But let's just say that's where they're going. 7.5% deficit expands pro-cyclically. I think it's puts us back into this world that we've been in, really in the post-COVID regime during mostly the Biden administration, where big deficits fuel parts of the economy, crowd out other parts of the economy. And so you have, I think as a strictly a capital markets investor, you have to be long stocks because the companies that make up the S&P 500, they're going to get theirs. They're going to feed at the trough of Washington, and they will make sure they make their cut, get their cut. The segments that are going to get hurt are the cyclical areas of the economy that we've already seen, like housing. Housing is on the verge of a recession right now. Existing home sales are at levels we haven't seen since the lows in 2009. New home starts are starting to make new lows. Our expectation is that you'll see layoffs in residential construction employment soon, and that the economy, the housing market can't handle a 7% mortgage rate. So you're having this bifurcation. It's the same goes for auto sales below 2018 levels. Durable goods sales depressed, not helped by the tariff situation either. All this stuff sets up for a bifurcated economy where, it's when you say, can the economy handle this? Well, yes and no. Some parts of the economy are going to thrive. Parts that are close to the government and parts close to those deficits are going to do well. And, but if you are credit sensitive, there's, and Trump wants Powell to cut rates and stuff like that, but cutting the Fed funds rate in this fiscal backdrop is not going to do anything but steepen the yield curve and push long-term rates up potentially. So, I think it has to. Everything flows from fiscal at this point, and so
yeah, that's the irony of it, right? The power to deal with interest rates lies with the president and Congress for a change, not the Fed, because fiscal seems to be driving the direction of rates.
Yeah, but doesn't that? It's just so like this to me. This whole saga has told me having the right model of the world is so important. I think if you don't have the right model of the world, then it causes a lot of damage. It can cause a lot of damage. And I see that, honestly, I see that in the tariff policy. I've seen that in the fiscal policy that we are on the verge of running and have been running. In that misunderstanding of how the world works is ideas have power, and that's what we're seeing when they're implemented.
So the government has the wrong model right now.
I believe so. Yeah. I think that we have a real problem with economic illiteracy in the ranks of our government. Across both parties. I hate when people, both parties, like, I'm not trying to just say that. It really is. It's rampant. Like, there's just not a lot of people who follow the data and have are grounded here. And so, and that was, I think, what happened with the tariff policy. Like, everyone was ready for like 10% across the board tariffs. We can all analyze the impacts there. There are trade-offs to that. It's a tax. We need revenue. So maybe that's the way you want to raise revenue. Okay. Maybe you're using it to lower tariff rates and get freer trade. Okay. Some industries need to come home. Okay. Like, these are all fine things. I think what really spooked the market is when Trump pulled out a poster board that implied that if there is a trade deficit with the country, then we are being ripped off, and it doesn't. The whole
Yeah, it went
system's worked off.
right. They lost control of the narrative at that point. When you talk about and I think that there are a lot of Americans. I don't think anybody and frankly investors internationally, but I don't think people give average folks enough credit. I think they all know that there's a lot of economic illiteracy and stupidity happening with some of these policies because they can feel it, right? Like things are not working. They're not doing well. I mean, that's why we see this voter anger. What about Scott Bessent? And to a certain extent, what about Howard Lutnick? I mean, these guys run massive financial firms. Surely they have economic literacy. Is it just that they are not always, I suppose, in the driver's seat?
So my honest opinion is that I don't know either of these guys. I know people who know Scott Bessent pretty well, and so I feel like I know the guy. And I know some of the research firms that he worked with closely during his time running a hedge fund. And I think he's our last best hope in the administration. I think he understands the world better than Navarro or Lutnick, wing of the party. It's a low bar, though, is the thing. And I do think Bessent has some blind spots as well, if I'm being totally honest. I mean, these are my opinion. I think he has some blind spots. I think he has like a sort of a doomer tendency built into him, which you see in a lot of these kind of macro thinkers.
Yeah, I was going to say it's the self-acknowledged bias that macro folks have.
Yeah,
right?
I mean, I can give into it too, but that's why you have to be so careful with like the data and the story you tell yourself, and like it's like. Usually the market really corrects those errors because like you can't persist in having a bad model and then make, do well in your investing. If your model it reflects reality, your investments will benefit. And if it's not reflecting reality, your returns are going to be subpar. So I think that Bessent's our best hope. I hear a lot of people, maybe more left leaning, who are quick to criticize him and act like he's a sellout. And I would say, like, let's flip it around and say, like, maybe he does understand some of the errors that were made in the initial announcement. And like, what do you want him to do? Do you want him to like resign in protest? I think that would be, again, it would be a limit down day for the S&P 500.
Limit down. I think that would freak people out more than a move at the Federal Reserve. And by the way, this is public service, right? It's hard. And when we talk about a lack of literacy and I use the word stupid economic policy, as a collective, people have stopped listening to each other and cooperating and learning from each other. So that's the part that I think is stupid. But in general, public service is hard. You have to do group activities and compromise with a lot of people who don't agree with you and from different parts who have different priorities. So it's super hard. And anybody who's willing to do it, I think we should give them the grace that they're trying. But we've obviously kind of, I think everywhere, and this is not, by the way, just a US problem. I think everywhere people have sort of are facing some difficult situations and taking the easy re-elective, I'm going to get reelected kind of road. And I think that's what's angering folks. When you mentioned the bifurcated economy, Warren, you talked about the S&P versus cyclical. What about high-end wealthy versus the lower end? Because that seems like what they're trying to address. But based on what you just said, it seems like it'll benefit, again, the high end who have money, and it'll hurt those who rely on borrowing for their car and their home and, their basic expenses.
Oh, 100%. Yeah. That's why, like, there's been all these stats coming out about the housing market and how broken it is, and how the average buyer of a house today was born, I think, in 1968. And the average buyer of a house 20 years ago was born in 1968.
Wow.
Something like 40+% of all homes now are being purchased with cash. And anecdotally, you hear a lot of stories about wealthy parents who are giving the down payment to their kids. And so, you can go backwards and say, if we're going to run a fiscal deficit like this, rates are going to be higher. That's going to be interest income to this wealthy cohort. And it just feeds this pattern that we've been in over the last 4+ years now. And so, yeah, I think that's definitely an area where the bifurcation shows up. And like, I think there's something that, like, I think the man on the street can sense there's something wrong, but they're not equipped to make, that's why leadership needs to emerge. They're not equipped to identify the problem. You need to have someone like Trump's kind of a lame duck already. Like, if he had a good mental model of how the world worked, then he's willing to take pain for tariffs. It's crazy to me. Like, I get not wanting to take pain and having self-preservation, but if you're going to like talk about a detox period and all this and that, like, my argument for a long time was like, cut spending a little bit, deal with the detox that comes from cutting a little bit of spending. And I'm not a deficit hawk. Like, I don't think we need to run a balanced deficit. I'm just saying you need to get the deficit from like 6.5% to maybe 5%. Maybe you go from $2 trillion deficit to $1.5 trillion. That's still a pretty stimulative deficit if you do it in the right way. I think it would send a massive signal to the bond market that we are trying to get our house in order. The bond market would rally, credit could expand. You would see things like housing and autos start to pick up and take the baton, and you would get a more balanced economy, in my opinion, if you were to take those actions. But instead we're not taking those actions. We're running the tariff game in a really haphazard, weird way. And now we are blowing out the deficit for the next 4 years and playing basically accounting games to make the math work over a 10-year period. But we all know when we get to the 2028 election cycle, if there's temporary tax cuts, they're going to be on the ballot, right? It'll be like, I want my SALT cap, and I want my no tax on tips, and I want my this, that, and the other thing. And so in high probability, the can gets kicked farther. And eventually, like you said, the bond market's going to have to force discipline.
Yeah. So let me ask you about that. First of all, you better watch out, Warner. You might get a job in the government. You might find yourself
I don't do well in a corporation, much less a government. Okay, nobody's hiring me.
Our viewers are going to start writing you in because there's a lot of sense in what you're saying here. You better watch out. I might become your campaign manager. So if there, how do I want to phrase this question? We think of this as a long-term problem, and you just laid out a scenario where stocks could do really well. It could sort of feel good for those who have access to that and who benefit from that, and who are going to do well off that. S&P, large cap, sounds like tech, maybe, wealthy people, the kind of same playbook we just saw. Is there any short-term pain? Is that bond, that unsustainable fiscal spending, kicking the can down the road, is it still a long-term issue, or is there something that could create short-term pain that makes this more of a now problem?
You probably get a little bit of a backup in yields, but if they were aggressive with the budget, it's going to kind of be determined by how aggressive they are with the budget. I don't think we're in that setup yet. I think everyone wants to jump to that game. I think it still has to marinate more. I mean, Bessent has basically held the coupon issuance steady. That's not going anywhere. So we know how much debt has to get floated. The Fed has ended QT essentially, which is a quiet but important thing, because when the Fed's running QT, like 500 at the height, the Fed's running QT, that's adding 500 billion annually to the deficit funding hole. If we have a $2 trillion deficit and 500 billion of QT that we have to fill that hole with, that was what we were faced with really for a lot of last year and in 2023. And the bond market digested all the paper, all the coupon debt. And so if anything, QT is going to reduce that number in the near term. And the deficit doesn't blow out this year. It'll be next year where it starts coming larger and coupon auctions get larger. And so I don't think we're there yet. It's really, there's enough natural buyers of the debt, and there's still enough concern about recession risk and how this all plays out, and making sure you have enough recession hedging in your portfolio. So I don't think we're going to have this runaway bond sell-off this year. I just don't think it's in the cards yet. When I walk through the different pools of capital that are going to be involved, I personally thought maybe, I thought there would be a different set of policies maybe. And also along with which, another thing, the reason I don't see the bond market selling off is because I think the Fed is going to start cutting again on towards the end of the year. And that's because inflation is coming down. Like you don't, at this moment in time, the three major vectors of inflation are basically dead. Oil is going to stay weak. The labor market is softening, and the housing inflation, shelter inflation, is also softening. So I don't think there's much scope for inflation to come through because of that. You've already seen real yields, like on the 30-year real yield is at I think it's making a new all-time high today. So you start in sending capital into the market there. But there's trimmers. Like you can see long-term, there are trimmers. We had a new cycle highs in the 2s10 yield curve, in the 2s30 yield curve, and in the 5-year 30-year yield curve earlier during this April time period. And to me, that's where the term premium lives. You hear a lot about term premium. Term premium is just kind of a proxy. We've modeled it out in a lot of ways for yield curve steepness. So, and when you look at a scatter plot of where the yield curve was pre-GFC, I think we're just going back to those norms. And we'll probably land there next year. So that's all to say. We've looked at it. I understand the concern. I understand the long-term problems for fiscal. I don't think it's going to blow up the stock market now. Otherwise, it would be overweight. So it's a concern probably more for next year and beyond.
Yeah. So what outperforms here? Like, what do you think does best in this environment? You're bullish stocks, but is it still US? Do you think based on a valuation level that it looks better elsewhere? A lot of people looking at Europe. Is it commodities, and is it still gold? What do you see outperforming here?
My international versus domestic recommendations, I just declare my bias. I have a strong home country bias. I know there are going to be periods of outperformance as we've seen for international stocks, but I'd rather be involved in domestic stocks here and try to play the catch up. I probably sound like a broken record, but this is what has worked, and what I think will continue to work is a quality bias. You need to have a quality bias. That means, what does that mean? Well, like our fund is quality as its base. And then we have our own trend system that goes on top of that, which, is my preferred way to get exposure. But you can work backwards and say, what doesn't work in a quality universe? I don't think that highly cyclical stocks work in a quality universe. I don't think small caps work in a quality environment. And we're still kind of late cycle, in my opinion. And so it's kind of a resumption of the bull market that we've been in over the last 18 months or so. And, Mag 7 got hit the hardest, for instance, in this sell-off. And I think they probably lead coming out of it. And Mag 7 is a great stand-in proxy for quality. So that's where I'm at. And I want to be long gold. I know that, like we said, real rates are making new highs, but gold's hanging in. The gold is showing all the markers of a secular bull market. And like we said, when you study secular bulls for gold, like gold will go nowhere for decades and then explode. We're in the explode phase right now.
So it's still happening, hasn't already played out? No,
this is a long-term move. This is a multi-year move. We'll go above 4,000 before it's over. I think you have to have gold exposure. It doesn't mean you go 100% gold in your portfolio. It's just you have to have a piece of your portfolio dedicated to gold.
Yeah, absolutely. Again, something people are wrapping their heads around. Warren, this was so fantastic. Your research is so thorough, and you really do a wonderful job of trying to cut through the noise. And at this time, it's something we need so desperately. So thank you so much for that. One of the things I love about your notes as well, and we talked about a little bit right before we came on, was that you have quotes at the start of them. And I think that this is not from, I don't know how exactly if this is your most recent, but I sent one of them to a friend, which is art consists of limitation. The most beautiful part of every picture is the frame. I thought that was absolutely fantastic because we tend to forget about that. Across a whole spectrum of different things. But this is one when we're just talking about, we're going to have this bull market. People are going to be really excited to hear that. But I think that all of us should continue to keep our eye on those long-term risks. And I don't know if you were talking about or thinking about this. Maybe you want to tell me. But the second one you had on there was, and the little screaming fact that sounds through all of history, repression works only to strengthen and knit the repressed. That sounds like a very interesting thing that we should keep an eye on.
I do think you have to keep your time frames in order. But the theme of a lot of those quotes and of that report was that we are going towards a place of financial repression in the American economy. And you can repress only so long. You can do this only so long before there is a populist uprising. And you do start creating constituencies that weren't necessarily natural constituencies before. And so I worry about that over the long term. I think that, we should try to design a society where a free market society. I'm a free market person, but we live in a macro world where it's not, I think Austrians are out to lunch, but like we live in a macro world where there's complexity and you have to understand the macro and try to facilitate the well-being of everyone across the spectrum. And so that's I think there are a lot of people who see that problem right now, who see that where we're at, but there's such a dearth of people, it seems, to understand the system or have the willpower to effectuate the change that would be needed to help the most. So
yeah, amen to that. Or put personal greed aside to participate in the conversation that would be needed, even if it comes at a little expense to all of us. I think you're right, but the warning signs are there. So such smart stuff, Warren. Thank you so much. I just love catching up with you. I appreciate it.
Yeah, it's always good. It's always good catching up, Maggie. Appreciate the invite.